Welcome to Module 4, Innovative Financing Measures for Drought Management, part of the course Getting Ahead of Drought. Innovative Risk Monitoring and Financing Options. Having covered drought fundamentals, monitoring, and anticipatory action in earlier modules, this module turns to how that action actually gets paid for, before, not after, the crisis hits. This module introduces innovative financing measures to manage drought risks proactively and explores the concept of risk layering, resource allocation, and the integration of financial preparedness into drought risk management systems. By the end of this module, you should be able to achieve the following objectives. First, understand the principles of drought risk financing and the concept of risk layering. Second, identify key financial instruments that support anticipatory drought management. Third, recognize how governments and institutions combine financial tools to respond to different levels of drought risk. And fourth, explore innovative partnerships and private sector engagement to mobilize resources for drought resilience. We begin with Section 4.1, Drought Risk Financing Concepts. As discussed in the previous modules, drought is slow onset and largely predictable, yet response financing is still often mobilized only after a crisis is formally declared, by which time costs have multiplied and the range of options has narrowed. This module looks at how governments and institutions can arrange financing in advance so that resources are ready to move the moment risk materializes, rather than months afterward. It introduces risk layering approaches, strategic resource allocation, and how financial preparedness fits into a broader drought risk management framework. There are two ways of financing the same shock, and only one of them is designed in advance: reactive or ex post financing. Funding is sought after a disaster occurs through emergency appeals or supplementary budgets. Speed and amount depend on donor response and political attention at the time. Both are uncertain. Proactive or ex ante financing, funding arrangements, thresholds, and response plans are agreed before a crisis. Once a pre-agreed trigger is met, resources can be released within days, not months. Let's define a key term: risk retention. Risk retention is the strategy that an individual or an organization bears the risk for potential financial losses and damages resulting from disasters, typically through earmarked reserves or the flexibility to access loans when needed. According to the Global Facility for Disaster Reduction and Recovery, GFDRR, for example, national contingency budgets and disaster reserve funds are the most common risk retention instruments. The risk stays on the government's own balance sheet. Now, let's contrast that with risk transfer. Risk transfer is where risk is transferred away from the government's balance sheet through a commercial contract that requires payment of a premium. The government then receives a financial payment from a third party upon the occurrence of an eligible disaster event, according to the World Bank. For example, sovereign catastrophe risk insurance and parametric or index-based insurance are the most common risk transfer instruments. Let's compare these two approaches directly across 4 dimensions. Where the risk sits. With risk retention, it stays with the government or institution. With risk transfer, it's passed to a third party: an insurer, reinsurer, or capital markets. Typical instruments. Retention relies on reserves, contingency budgets, and contingent credit. Transfer relies on insurance, reinsurance, catastrophe bonds, and risk pools. Best suited to. Retention works best for frequent, lower severity events. Transfer works best for rare, high severity events. And cost pattern. Retention has a lower average cost but limited capacity for major shocks. Transfer involves a recurring premium, but offers larger capacity when needed. Contingency planning is the process of establishing objectives, scenarios, and response actions in advance of a crisis, so decisions do not need to be improvised once a disaster is already underway. A contingency fund is the financial counterpart a dedicated pool of resources, often held within the national budget, that can be accessed quickly once pre-agreed conditions are met, without waiting for a supplementary budget process. Many governments hold a national disaster or calamity fund for exactly this purpose, replenished annually and released against predefined disaster declarations. Let's define one more key term: risk layering. Risk layering is an approach to disaster risk financing that combines risk retention and risk transfer instruments, arranged ex ante, to mitigate the financial impact of disaster events of different frequency and severity, according to the World Bank. For example, reserves and contingent credit absorb frequent, smaller events. Insurance and risk pools absorb rare, severe ones. Each layer uses the instrument best suited to its slice of risk. Different financial instruments and risk management strategies are suitable for different types of events. In a risk layer disaster risk financing strategy, adequate instruments are arranged across the respective layers of risk. In the lowest layer, budgetary instruments such as reserves or contingency funds address medium to high-frequency events with low severity. The risk is retained at a level that is optimum for the risk appetite of the entity retaining the risk. In the middle layer, the severity of events is higher, at moderate frequency. Contingent credit products, such as a catastrophe drawdown option or CAT DDO, provide this layer with rapid and uncomplicated access to liquidity at manageable costs. And in the highest layer, risks can be transferred using market-based instruments for less frequent but very severe events. This is the layer where insurance and catastrophe bonds are most cost-efficient. Source: Insur Resilience Global Partnership, IGP. This brings us to Section 4.2, Introduction to Key Financing Instruments. Each instrument in this session answers a different version of the same question. How do we get money to the right place at the right time? Contingency funds, pre-approved government reserves, released against a disaster declaration. Forecast-based financing, funding released ahead of a hazard, based on forecasts and risk analysis. Sovereign risk insurance, national-level parametric insurance, often pooled across several countries. Agricultural insurance, crop or livestock insurance protecting farm-level production and income. And shock-responsive social protection, existing safety nets that scale up coverage or benefits during a shock. Let's look at the first instrument in detail: the contingency fund, the most direct form of prearranged financing, money the government already holds, ready to be released on pre-agreed terms. It rests on three design elements: eligibility criteria, defined in advance what event and what severity allows the fund to be accessed; replenishment mechanism, rules for topping the fund back up after a disbursement, usually through the annual budget; and disbursement rules, who can authorize release, how quickly, and to which agencies or programs. The second instrument is forecast-based financing, or FBF. Forecast-based financing is a way of getting humanitarian funding to communities before a disaster strikes. It uses weather forecasts and risk analysis to activate the release of funding ahead of extreme weather events, according to the IFRC. For example, IFRC's forecast-based action by the Disaster Response Emergency Fund, DREF, and FAO's anticipatory action programs covered elsewhere in this course, in Afghanistan, Papua New Guinea, and Pakistan, are both built on this same principle. The third instrument is sovereign risk insurance and risk pooling. A sovereign catastrophe risk pool is a mechanism through which several countries pool their disaster risk into a single, diversified portfolio, retaining some risk jointly and transferring the excess to reinsurance and capital markets to access prearranged, rapid payouts after disaster, according to the World Bank, 2023. For example, the African Risk Capacity, ARC, insures its African Union member states specifically against drought risk. The Caribbean Catastrophe Risk Insurance Facility, CRIF SPC, operating since 2007, and the Pacific Catastrophe Risk Insurance Company, PCRIC, cover other regions and hazards. Most sovereign and agricultural drought insurance is parametric or index-based. The payout is triggered by an easily measured indicator, such as rainfall falling below a set level, rather than by a loss assessor visiting the affected area. This makes payouts fast and transparent. Once the index crosses its threshold, payment is close to automatic, often within weeks rather than the months a traditional claims process can take. The trade-off is basis risk. Because the index is a proxy for the loss rather than a direct measurement of it, there can be cases where a real loss occurs without the index registering it, or vice versa. The fourth instrument is agricultural insurance. Agricultural insurance is insurance that provides protection against loss of or damage to crops or livestock from specified perils, including drought, with claims measured on a yield, index, or indemnity basis, according to FAO. For example, Acre Africa, the Agriculture and Climate Risk Enterprise, provides index-based weather insurance to smallholder farmers across Kenya, Rwanda, and Tanzania, working with more than 10 partner financial institutions. Let's weigh the strengths and limitations of agricultural insurance. Strengths: it encourages farmers to invest in inputs and higher return crops, knowing a loss will be partly covered. It protects farm income and can improve access to credit, since lenders see the crop as less risky. And there are documented gains. Insured maize farmers in Ghana increased input investment by 13 to 17%. Limitations: there's basis risk. The index does not always track an individual farmer's actual loss. There's affordability. Premiums are often unaffordable for smallholders without subsidy, and it requires reliable weather data and delivery infrastructure to operate at scale. The fifth instrument is shock-responsive, or adaptive, social protection. Shock-responsive social protection refers to social protection systems designed to scale up or otherwise adjust quickly in response to a shock, expanding coverage or benefit levels to reach additional affected households without building an entirely new delivery system. For example, Kenya's Hunger Safety Net Program, HSNP, provides regular cash transfers to around 100,000 of the poorest households across 4 drought-prone counties, with a pre-agreed mechanism to scale up to additional households once drought early warning indicators cross a set threshold. Let's bring all 5 instruments together side by side. Contingency funds are best suited to frequent, smaller, foreseeable costs, with fast, pre-approved payout. Forecast-based financing is best suited to fast onset, forecastable hazards, with very fast payout before the event. Sovereign risk insurance is best suited to rare, severe national-level shocks, with fast payout, typically weeks, on a parametric basis. Agricultural insurance is best suited to farm-level production losses, with payout in weeks at season end. And shock-responsive social protection is best suited to vulnerable households facing income shocks, with payout in weeks as an existing system scales up. We now move to Section 4.3, Blended Finance and Private Sector Engagement. Let's define blended finance. Blended finance is the strategic use of development finance for the mobilization of additional finance towards sustainable development in developing countries, according to the OECD, 2018. For example, in drought resilience, this typically means using public or concessional funds to reduce risk for private investors, for example through first loss guarantees or subsidized premiums, so commercial capital is willing to enter markets it would otherwise avoid. Next, let's define public-private partnership, or PPP. A public-private partnership is a long-term contract between a private party and a government entity for providing a public asset or service, in which the private party bears significant risk and management responsibility, and remuneration is linked to performance, according to the World Bank. For example, governments partner with reinsurers and insurance companies to design and distribute sovereign or agricultural insurance products, as seen in the structure of the African Risk Capacity, and in Acre Africa's partnerships with more than 10 financial institutions. Let's look at 3 practical mechanisms that make blended finance and PPPs work. Reinsurance and retrocession. Primary insurers or risk pools transfer a share of their risk onward, expanding available capacity without requiring more premium from any single country or farmer. Premium subsidies and first loss guarantees. Donors or governments absorb the riskiest portion of a portfolio, so private insurers and investors are willing to cover the remainder. And results-based financing. Private or blended capital is repaid, with a return only if agreed resilience outcomes are actually achieved, aligning incentives across all partners. Public and humanitarian budgets alone cannot cover the scale of climate and drought risk that lower-income, drought-prone countries face. Blended finance and private sector mechanisms exist to close that financing gap. The goal is not to replace public responsibility with private capital, but to mobilize additional resources, money that would not otherwise flow to these contexts, alongside it. Session 4.3 in brief. Blended finance uses public or concessional funds to reduce risk for private investors. PPPs formalize long-term roles and risk-sharing between governments and private partners, and reinsurance, guarantees, and results-based financing are the practical mechanisms that make both work. Let's see how these instruments layer across the drought timeline itself, from months ahead through to afterward. Months ahead, forecast and anticipatory action, FBF, contingency window, and early procurement. Weeks ahead, livelihood protection, seeds, fodder, water support, and cash top-ups. During drought, scalable support, social protection, reserves, and emergency budgets. Severe or national, risk transfer, insurance payout, contingent credit, and donor finance. And afterward recovery, credit, grants, budget repair, and resilience investment. A drought financing plan should show which window opens first, second, and last. Let's ground this in a concrete country experience. Kenya. What was in place? Kenya's Hunger Safety Net program has been designed to support poor households in drought-prone counties. How it scales? During drought, additional households can receive temporary support using predetermined triggers and delivery systems. Lesson for financing. A registry and payment system are as important as the financing instrument itself. For drought, the delivery channel can be the bottleneck. Scaling social protection helps turn early warning into household support. A dedicated course on climate finance, Climate Finance 101, Fundamentals, Architecture, and Risk-Informed Financing Pathways, is available, which provides more detailed information on climate finance and related subjects. To enroll in the course, use the link provided on this slide, tinyurl.com/reap-8pc-cf101. This brings us to the end of Module 4 and to the end of this course. We've covered why financing needs to be arranged before a crisis, the concepts of risk retention, risk transfer, and risk layering, 5 key financing instruments and how they compare, and how blended finance and private sector partnerships help close the financing gap. Illustrated through Kenya's experience with shock-responsive social protection. Thank you for your attention.